Estate Fix with Rich. I'm your host, Rich Szerman. Thank you guys for tuning in. I always like it when people listen. It's loads and loads of fun. You're listening to KHTS 98.1 FM, AM 1220, your hometown station. And for reasons I still do not understand, they gave me a show. So we're going to enjoy that a little bit today. We're going to do a little bit of a market update, as we always do. We're going to talk interest rates and houses prices. We also have the specialist of special guests on this week. We have a regular contributor to the show. My wife, Jane, is going to be on. She's the one with the law degree in the MBA, so we like to ask her questions whenever possible. And we had a lot of questions over the last 2 weeks. We did a show about 2-3 weeks ago about reverse mortgages, and we were spotlighting one client of ours named Beverly Fox, and the station did was nice enough to do a article about her and about some of the issues she's facing with her reverse mortgage being in foreclosure. And we've gotten a lot of response to that, both to that article and both to the shows we've done about it. So we thought we got a lot of questions about reverse mortgages, so I asked Jane if she'd do us a favor and come in this week and get some of those questions answered for you. Because I think if I'm getting those kinds of questions, I think everybody has those kind of questions. So we'll ask Janie about it. And then last but not least, we're going to wrap up the show talking about some of the stuff that we do under the heading of Public Pressure Works. If you're in trouble with your mortgage or with your house or whatever else is going on, and it's you against a large institution like PHH or like Harrington or any of these guys who are less than reputable in my view, there are things you can do to bring about public pressure to make them change their mind, even though they legally don't have to, and you're not compelling them to with the law. But there are things you can do. So we're going to talk about that a little bit because we're all about solutions here. So let's do a little bit of a market wrap up first, because I know you guys want to know what's going on. So we've got a great article here, which is emblematic of what's going on from USA Today just yesterday. And the title is Current Mortgage Rates Are the Highest They've Been Since 2001. And that is just a sad fact. The current mortgage interest rate is right now around 7.2%, and that is the highest it has been in 22 years. So makes it rough. So if you know a realtor out there, you know anybody in the real estate industry, escrow, title, whatever, give them a hug, because goodness knows we could use it. There is so much less real estate being sold as a result. But let me read this to you. Home buyers' purchasing power diminished further in August as mortgage rates continued their upward march, averaging 7.2% over the week ending this Thursday, the highest level since 2001, according to the newly released data by Freddie Mac. Mortgage rates climbed to the highest level in more than 2 decades the week prior, averaging 7.09. A year ago at this time, and this is the number that blows my mind, a year ago at this time, the 30-year FRM, fixed rate mortgage, 30-year was 5.5. So we've gone up almost, well, in most places, a full 2 points in just 12 months. And that is not what's supposed to happen. That is not good for the real estate industry. Anyways, no less an authority than Sam Cater, Freddie Mac's chief economist, said indications of ongoing economic strength will likely continue upward pressure on the rates in the short term as rates remain high, supply of unsold homes woefully low. Incoming data shows that existing home sales will continue to fall. I don't know how much more they can fall. We're already in Southern California. We're down 35 to 40%, depending on which chart you look at. And again, I always like to make sure you guys know, I'm not talking about housing prices. Housing prices are actually up a little bit still. But the volume of houses, the number of houses being sold, is down between 35 to 40%. So think about that. Whatever business you're in, if you sell widgets or whatever you do, think about 40% of your business just going away. And if you work for a company and they lose 40% of their income and doing 40% less business, they're going to have a hard time keeping everybody employed. And that's what's going on in the real estate industry right now. We are losing realtors at a furious rate, and it's just tough out there. It really, really is. So, and if you're a buyer, and this is what's charging all this, what's really happening is the economy, the real estate economy, if you like, is shrinking, and it's shrinking in equal measure. It's supply and demand dictate price. Supply and demand dictate value in the broad strokes. And what's happened, because so many people have low interest rates, like sub 4, Fannie Mac tells us 70% of everyone in the United States that has a mortgage rate that's 4% or below. If you go 5% or below, that number is 85%. So that's a very small percentage who have interest rates. That's only 15% of interest rates above 5%. And those are the people who you're looking at selling these days. And if your interest rate's that low, why would you sell? Your payment would go up dramatically, and it's the killer. I mean, I understand the Fed is trying to curb inflation, but taking it out on the real estate market, I don't think is the way to do it. But again, they didn't ask me. But anyway, Federal Reserve's interest rate hike to fight inflation have driven the yield on the 10-year Treasury bond, a benchmark for pricing an average 30-year loan, causing mortgage rates to climb. According to data from the Mortgage Bankers Association for the week ending August 18th, mortgage applications decreased 4% from 1 week earlier, and purchase activity fell to a 28-year low. Ooh, that's a terrifying number, 28-year low. According to Joel Kahn, MBA's vice president and deputy chief economist, applications for home purchases mortgage dropped their lowest level since April of 1995. As homebuyers withdrew from the market due to the elevated rate environment and the erosion of purchasing power, low housing supply is also keeping home prices in many markets, specifically ours, high, adding to the affordability hurdles facing most buyers. So in other words, if you're looking in high-value areas, Southern California, New York, Seattle, places like that, although Seattle has slipped a bit, what you're looking at is a situation where most people cannot afford to buy. Most first-time buyers can't get into that market. So first-time buyer doesn't go, the second-time buyer doesn't go, the dominoes don't fall. And that's what we're looking at. And I'm very, very concerned that we need to pull out of this. And the Fed is going to raise the interest rate again before the end of the year. I know this is going to happen. And it just depends on how the bond market reacts and the stock market reacts as to what it does to the real estate interest rate on 30-year mortgages and 15-year mortgages. But it's getting ugly out there. It really is. So the big question is, why are home sales falling? Higher interest rates can add hundreds of dollars to a monthly mortgage payment. More than 85% of current mortgage holders are locked into an under 5% mortgage interest rate, which makes these homeowners reluctant to trade in their homes for another at today's high interest rates. And this is a big number. Nationwide sales of existing homes fell another 2.25% in June. Those are seasonally adjusted numbers. Fell from June. Those are the July numbers. And August is going to be even worse. So a rate of 4.7 million homes sold in July nationwide, according to the National Association of Realtors. Year over year, sales were down by 17%. That's nationwide. In Southern California, it's a lot worse as far as the amount of sales. And it's weird for us because our prices stay high. Anyway, total housing inventory at the end of July was 1.11 million properties. Nationwide, that sounds like a lot until you think about the fact that we've got about 360 million people in this country. That's down 15% from 1 year ago. Unsold inventory sits at a 3.3-month supply of the current sales pace, which is still considered to indicate a seller's market. Not enough inventory on the market, sellers get to call the tune. The median existing home price for all housing types in July was $406,700, an increase of 1.9% from July of 2022, and it was $399. But according to newly released data by the U.S. Department of Housing and Urban Development and the U.S. Census Bureau, sales for newly built single-family homes in July increased 4.4% to $714,000 seasonally adjusted annual rate. The pace of new home sales in July was up 31.5% from a year ago. New homes are selling because there's not enough stuff in the resale market. Currently, of the total available inventory, including both new and resale homes, 31% of homes available for sale are newly built. And traditionally, that number is about 20%. So the fact that it's now 31% is a pretty decent growth. According to the Builders Association, the median new home sales price in July was $436,700, which is roughly $36,000 higher than the average resale in the United States. Average resale is $406,700. Average new housing price $436,700. $30,000, about 8% premium is about right for new housing. And that's down 9% compared to a year ago. Pricing is down both due to builder incentives and a shift toward building slightly smaller homes. Builders are offering all kinds of incentives to get people into houses now because the interest rate's so high. A lot of them own banks, which you literally do that. Anyway, according to Jeff Taylor, member of the Mortgage Bankers Association and founder of Emphasis Digital Risk, which does due diligence on mortgages for the largest banks and lenders, although existing homes account for 85% of the U.S. sales, it's time for consumers to take a closer look at new home sales. Many builders are offering to buy down mortgage rates as much as 1 to 1.5 points, which can save buyers thousands or even tens of thousands of dollars, depending on the price of the house and the type of mortgage. Most large home builders have their own mortgage companies, and that's how they have the flexibility to do this. In other words, if you're looking to buy a house right now, you may be missing a bet if you're not checking out new housing. I think you're going to have a little bit more, in general, a little bit more options with new housing. You're going to have a little bit more leverage as far as what they can do for you. Maybe buy your interest rate down to 5.5% from the 7.5% it's at now. Whatever the circumstance may be. They're also offering all sorts of incentives. There's one builder I saw in the Midwest that's offering, they give you a car and a pool. If you buy one of their houses, they'll build you a free pool and give you a car. So there's all kinds of incentives out there. But you got to know how to take advantage of them. That's the other thing. If you do want to go look at a new home, don't go by yourself. Take a realtor. Take a realtor with you, and it's very important you take them with you on that first visit, because there's something called a procuring cause, which we can talk about later. But what it means is that whoever showed you the house, the realtor is with you, showed you the house, even new houses, becomes the realtor for the deal. They are the procuring cause. It's more complicated than that. That's the basic idea. So if you are in the market to buy a house right now, take your realtor with you. Go take a look at new houses. We sell new houses all the time. It's great fun. People like them a lot. It's easier to do most of the time, and we get a better deal out of it because we know what we're doing. So builders don't deal too much typically on the price of the house because that's published. They don't want to cause a problem with the next buyer, but they will deal a lot on incentives. Carpet, paint, upgrades, this, that, a pool, in the case of the house in the Midwest, and a car. So there's a lot of different stuff out there you can do. So take a realtor with you. What I would strongly suggest is if you're looking to buy, what I'd suggest if you're looking to buy a house, give my office a call, because we have a program where we'll give you money to help you buy a house, the rental rebate program, where if you're renting, we'll give you 10% of the rent you have already paid back to go buy a house. And it's real money. You can use it for whatever you want. As long as it be charged through escrow, you're good to go. And it is pretty substantial. I mean, the average rate in Santa Clarita here now is approaching $4,000 a month. We're talking about a lot of money. You're talking about $48,000 a year. That's what is that? $96,000 over 2 years. 10% of that's $9,600. It's almost $10,000. We'll literally give you that to go buy a house. So that's real money. The numbers are large. We'll help you do it. So we give away money for all sorts of stuff. So if you are looking to buy a house, you might want to give us a call. But for sure, take your realtor with you when you go to a new housing tract, because you will get a lot farther with a realtor representing you than you will on your own. That is for certain. I want to talk about some of the prices and what's going on with some of the prices nationwide. I don't want you guys to miss out on this, because this is important. In our area, prices have held steady. We're doing fine price-wise. Even gone up a little bit because we're Southern California and people want to live here. But you got to watch what's going on in the rest of the country, because prices are falling. So according to the good people at Realtor.com, here are the 10 cities where on average the prices have fallen the most year over year. Number 10 is Chicago. They've dropped to the median listing price of $376,000, which is down 1.1%. Not a lot, just change year over year, 1.1%. Nobody's going to lose their shirt over 1.1%, but it's still a lot of money. Sacramento, California is number 9. It's the 9th worst housing market where housing prices are falling. Sacramento has dropped 3.4% to a median list price of $662,000. That's roughly $22,000 lower than it was last year. So if you got a house in Sacramento and you sold it last year, you could have sold it for $22,000 on average, $22,000 more than this year. Winston-Salem, North Carolina, they're down by 3.6%. Pittsburgh is down by 3.9%. Salt Lake City down by 4%. Number 5, Sarasota, Florida, they're down by 4.7%. Phoenix, Arizona, median list price is now $529,000. They are down by 5.6%. So if you sold a house in Phoenix last year, you could have sold it for about $30,000 more than you're going to sell it for this year. Myrtle Beach, South Carolina, they're down 7.3% to an average listing price of $366,000. They're down $26,000 on average. Austin, Texas, which was a boom town during the pandemic. Real estate in Austin was going through the ceiling. They're down 7.7% to a median list price now of $583,751, or $42,000 less than they could have got a year ago. That's a lot. That's a heck of a drop, 7.7%. $42,000 if that you've lost if you didn't sell your house last year in Austin versus now on average. And Boise, Idaho, number 1. Boise, Idaho is down 7.8%, almost as much, or just a little bit more than Austin. The median list price in Boise, Idaho now is now $609,875. They are down $47,500 from where they were last year. So if you're in Boise, you really should have sold last year. Same is true of Austin. Now, the reason I bring these things up is not because I think there are a lot of people who are listening to the show who are contemplating buying real estate in Boise or Austin or Myrtle Beach or Phoenix or any of these places. It's because you need to pay attention to what the rest of the country is doing. I would submit what the rest of the world is doing, but especially the rest of the country is doing, because that is going to be what happens here next. California, especially Southern California, is a great big economy. We do all kinds of stuff here. There's so many industries in here. And so when one goes, another comes in, one's weak, another's strong. So we balance out pretty well, all things considered. But we still cannot escape the overall economy. And what I'm here to tell you is prices here are going to drop. The interest rate is going to go up more. We are likely going to hit over 8% by the end of the year. I really hope I'm wrong about all of this. But I think we're going to be at 8% by the end of the year, and I'm not alone. There are a lot of people who are smarter than I am who say this, because the Fed is going to raise the interest rate one more time at least before year's end, and I think the stock market is going to react positively to it, which is not good, not for interest rates. I think you're going to see an interest rate now that is around 7.2, 7.3, 7.5 is sort of a standard. We're going to see the standard grow to 8%. And I'm very, very worried about what that's going to do to the real estate market. We're already down nearly 40% in volume. This isn't going to help. So yeah, we're going to have a problem. So if you have a house to sell, you might want to do it now, because inventories are very, very low, and that is not going to stay that way. So it's problematic. I want to go to one more thing for you guys. According to Freddie Mac, we talked about this. The 30-year fixed interest rate as of this morning is 7.23%. That's the average. So there are plenty of people getting 7.5. There's some people getting 6 3/4, but 7.23 is the average. That's the highest in 22 years. Last year was 5.552%. Last year at this time. 6 months earlier, it was down to 4.5. But 5.5. Now, here's the comparison. Let's say you're in Santa Clarita, and let's say you have a $600,000 loan. The average is around that for us, a little low, on the low side, closer to about $700,000. Let's say it's $600,000 for the purposes of this example. On a 30-year fixed, a $600,000 loan at 5.52%, the average last year was $3,426 a month. $3,400 a month is your payment, not including taxes and insurance. That's payment interest. That same exact loan, those same exact circumstances, $600,000 on a 30-year fixed, at the current interest rate, today's interest rate of 7.23 is $4,085 a month. That's $659 difference if you bought the house last year versus buying the same house this year. That's $7,908 a year, nearly $8,000 a year. And a lot of people just don't want to do that. They want to move up. They don't want to move sideways. Why would I spend an extra $8,000 a year? Or if your interest rate is lower than 5.52%, even worse, to sell my house. Community bankers just did a survey, which I want to get into real quick. Recent public survey. Wasn't scientific, which is a public internet survey. But these numbers are staggering. 58% say we are already in a recession. 19% say the recession will come later in 2023. Those two numbers combined are 77%. 77% of the people who got into this poll do not believe the economy is doing well now or is going to do well in the future. Only 4%, that's it, 4% say a new economic paradigm has ended recessions. Let me read you this article from the good people at First Tuesday. By the way, if you're into real estate, First Tuesday is a great site. You should be paying attention to this. They're fantastic. According to First Tuesday, the recession declaration continues to loom in 2023, with pronouncements about mixed signals pointing in different directions as the economy slacks. Will our buoyant job market and equipment demand help the U.S. economy achieve fabled soft landing promised by dovish economists? Or will it crash and burn? That's the question. Unfortunately, I'm seeing I'm more on the crash and burn side, but I hope I'm wrong. 95% of community bankers proclaim the economy is already in a recession as of Q2 2023. According to the Conference of State Bankers Supervisors, the CSBS, this is part of the current trend toward hoarding of cash. Further, the CSBS quarterly survey in Q2 of 2020 saw its most foreboding responses about the economy since the survey began in 2019. According to small bankers, 63% of bank supervisors expect future business conditions to get worse, and 53% of bank supervisors expect reduced profits. These are not good signs. It's awful. 70% of respondents expecting future monetary policy to result in worsening banking conditions. 84% anticipate more intense pressure from governing regulations. Today, it's evident that the widespread between treasury rates and fixed rate mortgages is by design slowing the economy. The spread between the 10-year Treasury note and the 30-year mortgage, 30-year mortgage, historically hovers around 1.5 percentage points. However, beginning in 2022, the spread has remained near 3 points, twice the typical spread for normal economic conditions. This doubling down indicates lenders are padding their risk premiums in anticipation of adding increased rates and mortgage defaults. In other words, it's going to get worse before it gets better. Small bankers are always a good people to ask because they're small community banks, and these are all across the country, and they're telling us, 84% think it's going to get worse because of the government. 70% expect future monetary policy to result in worsening banking conditions. These are not good things. These are very bad headwinds. So if you got a house to sell, I would do it now. If you're looking to buy, get into the market now, start looking around now. But as far as buying, depends on what you're looking for, depends what your life is dictating, because the interest rate is high and it's going to get higher. So, the ethos that seems most of the investors that I talk to in real estate and some of the bigger investors I listen to, the ones who are national investors, what they're telling, their mantra throughout their companies is survive to 25. They think, I think that's kind of short selling 2024, but they're all saying the same thing. Survive to 25, because the real estate market is going to be a mess over the next 18 months. It's not going to reach normalcy until 2025. So, happy to share that good news with you. Always happy to bring a ray of sunshine into your life regarding real estate. We're going to go to a break right now. We're going to hear from some of our sponsors who always like to pay the bills. It's always fun. Keep things rolling. And when we come back, we're going to have a very special guest, my wife, Jane Szerman, and we're going to talk to her because she's the real estate attorney with the MBA, the brains in the operation. We're going to talk to her about reverse mortgages because we got a lot of reverse mortgage questions over the last 2 weeks, and I want to get them answered for you guys. So enjoy the break. Please stay with us and be here when we get back. We'll talk to Jane, the smarter part of the operation, about reverse mortgages. Credits, I appreciate that. Listen through the ads, I appreciate that. And if you didn't listen, you're just tuning in now, thank you as well. I always like when people listen. It's always more fun when you're behind the mic, when you think people are listening, or when you know people are listening, even better. Today, as promised, we have a special guest, Jane Szerman, my wife, real estate attorney and MBA. She has her MBA, and she's frankly the smarter part of the operation here. We did a show, about 2 weeks ago, 3 weeks ago, a month ago. It was a month ago. We did a show a month ago about reverse mortgages, highlighting one particular client as emblematic of sort of that industry. And there are a couple of things I want to mention about reverse mortgages before we start asking Jane questions about it, because I do want to get all your questions answered. But a couple of things you need to know about first mortgages as a baseline before we go forward. First of all, the number of foreclosures, the percentage of foreclosures in the reverse mortgage part of the industry versus standard, conventional, or government loans is unbelievably high. The percentage of reverse mortgages nationwide that will go into foreclosure at some point is 10%. That's 1 in 10. Compare that to the regular standard mortgage, conventional or government mortgage, you're looking at a fallout rate of around 1.5%. So that is a big difference. And I think a lot of it is because I don't think they're necessarily, I think there's nothing wrong with reverse mortgages. I'm not against them. I think they can be a fine economic product for people, but they have to be administered properly. So I don't stand in opposition of direct mortgages, but I absolutely stand in opposition to companies like PHH and Carrington and Aquin and these guys who abuse it because they're taking advantage of a vulnerable population and they're getting away with it. And I find that really offensive. So know that as a baseline going in, but let's talk about reverse mortgages. We've got a lot of questions. Let's start here. The first one we got, this one comes up a lot. So I'll ask Janie. First of all, welcome. Thank you for coming on the show.
Oh, of course.
Always try to be nice to you because that way you're nice to me later. Always good. Always good. Can a family member take over a reverse mortgage?
Well, I think it's important to remember that a reverse mortgage is limited in terms of who qualifies. It's only for homeowners that are 62 and older and has very specific restrictions and requirements. So a family member is not going to be able to automatically take over the loan by any means. They might, under some circumstances, qualify to get their own reverse mortgage, but they aren't going to be able to take over the loan.
Well, reverse mortgages in general aren't transferable. So it's not like you might have a VA mortgage, and if somebody else who's VA, they could take it over potentially, or a standard mortgage that allows, there are very few of these, but that allows somebody to take over the mortgage. We're going to see more and more requests like that as time goes on because the older mortgages tend to have very low interest rates, the newer mortgages have very high interest rates.
Yeah.
But there is no such thing as a reverse mortgage that is assumable. It does not exist.
Yeah, I've not seen one before. It's specific to the borrowers at the time.
It does not exist. But there is some good news, though. If you are a family member, please correct me if I'm wrong, but if you're a family member and you are taking over sort of the property, what you can do, like let's say the house is worth $500,000, but the amount of the reverse mortgage has blown up to $600,000. If you're a family member, you don't have to pay that $600,000. I don't think family members. No, it does have to be a family member taking it over. I can't remember. I think it's irrelevant.
I think it has to be a direct family.
So if you're a family member, you inherited the house and it's worth $500,000, and there's a $600,000 mortgage, you can actually buy the house for I think it's 90% of the appraised value.
I believe it's 95%.
Or 95.
But it's not related to. It's not paying off the mortgage that's owed on it, and it's not even 100% of the value. It is 95%. So that is at least better than the alternatives.
So that way, if you do have a reverse mortgage and it's gone over the value of the property, you're not necessarily destroying, you're partially destroying, but not entirely destroying generational wealth because the family member or whoever inherits that property has the ability to buy it at below market value because it's market value less 5%.
Yeah, presumably with cost that puts them back, at around where they started, but at least they're not in the hole, so that is a positive.
Although with the current interest rates, it's probably going to put them in the hole.
Yeah.
So no, you can't take it over, unfortunately. Okay, I'm going to ask you these next three questions. Before I get into these, I want to make sure we go over this. The three basic responsibilities of having a reverse mortgage. If you know nothing else about reverse mortgages, know these three things. They are that you have charges you must pay. Your property taxes and your insurance, you must pay. If you do not pay them, you will go into foreclosure. The bank will typically step forward and pay them for you, and then they will add it to your bill. They will take it out of the money that your equity in the property, and then they will send you to foreclosure. You have to keep up those things. You've got to keep up property taxes, insurance. That's number one. Number two, you've got to keep the home in good repair. And that's kind of a nebulous sort of thing. What does good repair mean? Yeah. It's pretty general, but you have to keep the home in decent shape. And number three, which is the one that gets most people in trouble, the home must be a principal residence and you must be occupying it. And this is where we get into big trouble with reverse mortgages because the banks play hard and fat, play loose, very, 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 very loose with the rules. Because, and again, correct me if I'm wrong, but I believe the law on the subject just says you have to be alive and occupying the property. It doesn't say you have to report same to the bank.
No, but typically that's the lender's requirement of their own rules and their own loan documents. So it isn't a law out there, but it is a requirement that the bank has. And if you don't send in that certificate of occupancy, that triggers the bank to assume that you don't live there anymore. And while they are required and do say that they follow up and try to visit the property and try to contact the homeowner, the circumstances, the clients that we've seen that have had that happen, as soon as they don't return that certificate of occupancy, that seems to be the only thing,
they don't.
The only attempt to contact them.
They don't. The bank doesn't do their due diligence. They do not do what the law requires. They do not do what HUD requires. They lie. They flat out lie. And when they lie, they charge the client for it. And if I sound like I'm a little annoyed on this topic, you're hearing me correctly. I'm extraordinarily annoyed on this topic. Because in one particular client's case, when we've been talking about the one that was highlighted in the story, the bank claims to have gone out to that property and knocked on her door. They said this in writing. They knocked on her door. Not once, not twice, not three times, 4 separate times. Now, it took some doing, but we got a hold of the reports that were supposedly generated by these companies knocking on their door. There is not a one of them who got past the guard gate at Friendly Valley. They didn't try. And I know that because in the report you have to have a picture. And the only picture they have is a picture of the guard gate. Now, Beverly Fox's house is about 1.5 miles away from the guard gate. So unless these inspectors went to the guard gate and just yelled out Beverly's name and hoped for an answer, they didn't go knock on her door, which is something they are required to do, and they have flat out lied about. Now, they also say they're sending letters and everything else. I don't believe that either. And this creates a problem. Now, again, it's not the problem with the reverse mortgage. The rules that are in place are good. They protect the consumer. But they get abused by companies like Carrington. They get abused by companies like PHH. And that's why the fallout rate is as high as it is. So anyway, knowing that, let's move on to the next question. Do I pay mortgage insurance on a reverse mortgage?
Yes. There most definitely is mortgage insurance. In fact, it's quite expensive. You pay a larger amount up front, and I believe typically a larger amount every single month that you have the loan.
And the reason for that is the insurance companies, the government insurance, will essentially tell you that, well, hey, if the house goes to $600,000 and it's only worth $5,000, and they can come in and buy it for $100,000 plus less, we got to find a way to cover that to pay for the program. So mortgage insurance on reverse mortgages is extremely expensive, even though that scenario I just played out there is very rare. But yeah, it's very, very expensive. So they absolutely pass that along to the consumer. And we talked about this a little bit. I'll ask. We get a lot of questions. What is an occupancy certificate?
It's just a letter that the bank asks homeowners to sign that certifies under penalty of perjury that they still occupy the property. And what is required officially, because it is a specialized type of loan, is 6 months and 1 day. The property out of a year, the property must be the principal residence of the borrowers, or at least one of the borrowers. That becomes an issue as people get older, and one or both may need to have another alternative living arrangement with more help, like assisted living.
Yeah.
That then gets very complicated.
Yeah, because, if you don't return that certificate, it actually gets better than that. You and I haven't had a chance to talk about this. This happened in the office yesterday. We have one client that we're working on right now. We've got a reverse mortgage with Carrington that's gone south. I won't bore you with the whole story, but she sent in her occupancy certificate, and they rejected it. And the reason they rejected it is because they have on file that her daughter, who happens to be a homicide detective in Las Vegas, her daughter has a power of attorney. So they will not accept the occupancy certificate from the woman who lives there, whose home it is, who is on the loan, and she is, by the way, perfectly fine. They have to get it from the power of attorney.
No, that makes my brain hurt, because that's not the way powers of attorney work. It doesn't remove the ability of the person to sign for themselves, but okay, yeah, that's a new one.
I
haven't
like
run into that before.
Carrington Mortgage has now decided that the owner of the property, who resides in the property and whose mortgage it is, clearly is dead, because even though she has signed an acknowledgement saying she is very much alive, Carrington has decided, because her daughter, who has power of attorney, hasn't signed off on it, she is clearly dead, and they're going to put the house back into foreclosure, which we only just got out of foreclosure. Obviously, we're not going to let that happen. Those of you listening, I will fix this. We will get it taken care of, because this is ridiculous. But this is the kind of nonsense you see. I mean, there's nonsense all over the mortgage industry. But in reverse mortgages, there just seems to be more of it. Again, 10% of all reverse mortgages in the United States will face foreclosure at some time. Now, most of them won't go into foreclosure, but they'll be facing it. And the reason for that is when it goes into foreclosure, the banks get to charge additional fees. So they put it into foreclosure, they roll up $5,000 or $10,000 in fees, and then they take it out of foreclosure and then blame the consumer for it. The consumer, over 62, one client's 85, another one's 90 that we're dealing with right now, they don't really notice that. And what happens is that just added to the balance sheet that they have, so they owe $5,000, $10,000 house more than they would otherwise. And when a family member comes in, if somebody passes away and gets the house, they don't know that there's an extra 10 grand on there. It is that's the other problem, extremely hard to audit these accounts. Yeah. On a regular mortgage, there are very strict rules that the bank must provide a full and complete accounting anytime you ask. They have 30 days. With a reverse mortgage, same rules, different application. They apply codes and things, so you cannot tell what they're doing. They intentionally obfuscate, and I'm talking specifically about Carrington, PHH, and Aquin. They intentionally obfuscate the hide, that is the data, so you can't figure it out. It's completely insane. We're going to fix it, but it's completely insane. One step at a time. Anyway, next question, do I have to pay property taxes, or does the bank pay them?
No, typically the owner is required to pay the property taxes, insurance, HOA, upkeep, anything related to the property on an ongoing basis. The owner has to pay it.
What we just touched on, can I ask my bank for an accounting?
Yeah, absolutely.
Yeah, the law is they have to provide it.
Like you said, it's going to be a little hard to read, but at least you get that. That's a place to start.
They're going to make it as complicated as possible, though. This is a good one. Can I use a reverse mortgage to buy a home?
Yes.
Yeah, you absolutely can.
Yeah, oddly.
Yeah, we've had a couple of clients do that where they were in a standard mortgage and they sold that house, had a lot of equity in it, and then instead of getting a standard mortgage and converting it to a reverse mortgage, it was a lot cheaper for them to just go straight into a reverse mortgage. So you can absolutely use a reverse mortgage to buy a house. You still have to qualify and all the stuff you do with a normal mortgage, and you still have to have your pre-qualification letter and your underwriting certificate, all that good stuff. But yes, you can absolutely do that. Can anyone take out a reverse mortgage?
Well, like we're talking about, not everybody. It's basically the age of the homeowner is really the primary determining factor there. And then beyond that, they have to be qualified for certain minimum payments, and it can only be a maximum percentage of the home value. So there are other restrictions, but generally homeowner 62 and over.
Usually if you have equity in California, it's not that hard to get a reverse mortgage, as long as you're at least, 62? Right?
Yeah, 62 and over. But again, it's the value is a limiting factor. It's not going to be exactly 60%. There are a lot of factors that go into it. It's one of the things that makes it a very complex financial transaction, is that the amount you qualify to borrow is determined by a variety of factors, including an average 10-year fixed interest rate and the age and the value of the property. There are a lot of factors, and that just goes in to determine the percentage that you can afford, or that you can qualify for the loan, and then beyond that, then you get an actual interest rate that you're paying that it comes out of the equity in the property.
Yeah, so anyone can get a reverse mortgage, but the older you are, the better mortgage you tend to get. Because if you're 62, you're not going to get as good a deal as if you're 90.
Right. I mean, that's unfortunately just a matter of statistics and the amount of money there.
The unfortunate calculus of debt.
And that's something to keep in mind. I'm a big believer in information and knowing what you're getting into. Like we said, I'm not opposed to reverse mortgages across the board, but the younger you are, the more you're going to add to the balance, and the odds that you're going to have money left over in the property down the road, if you need it in 20 years, are very low. Yeah. And that's not just a matter, because I've heard people say, well, my kids are fine, they have good jobs, they don't need to worry about it, which is fine, and that's certainly a factor, but you're also forgetting that some people need the money from the house in order to pay for assisted living, or to pay for home health care, or to pay for other things.
Which is a great lead into my next question. We got this, 3 or 4 people asked me the same question. What happens if I have to move out of my home to a nursing facility or move in with family?
Well, then you are not living in the property anymore, and the reverse mortgage is due and payable. Yeah. So they will foreclose if you don't resolve that by paying off the loan or selling the property or doing something like that.
What we've seen with a couple of clients is I hate to say this, they really should be in a managed care facility. They are not in the best of shape, but the family knows they can't leave that house. If they leave that house, somebody's going to have to come up with the money to pay for it, and no one has the ability to pay off that mortgage. So she's got to stay in her house, which is not necessarily the best thing for this particular, at least they tell me. She seems perfectly happy in her house. But her family has told us repeatedly, the doctor has told us repeatedly, that this is not the best environment for her. But she's got to stay in that house or she'll lose it.
Some people need extra care, which they can't afford.
Yeah, I think that's a really unfortunate loophole in reverse mortgages in general, is that if you're lucky enough to live to be 85, 95, whatever it is for you, you may be in a position where you may spend the last years of your life in managed care. You may need that. I'm not saying you're going to have a bad life or anything out of it. And I'm not talking about hospice care. I mean, living your life just because you need some help.
Right.
We've been through that with our parents. And you may, if you have a reverse mortgage, you may deny yourself the ability to do that, both because you won't have the equity. Now, granted, maybe you've been living on it up to now, so maybe that makes some sense. But worse yet, you may find out, like in this case, where you're essentially trapped in the home. Yeah. Because if you move out, go to managed care, something that you need, and the bank knows about it, you're going to lose your home. Or hey, what if you're in a situation where you're actually, God forbid, in the hospital for more than 6 months in a day?
Yeah,
you could lose your home over that too.
You're not living there anymore.
Now, you can apply to HUD, and you can ask HUD for a variance on these things, because ultimately it's HUD who has to decide who forecloses, right?
Right. They get discretion because, right, as you said, not all of the loans, but all the loans people are going to take out.
Yeah, the HECMs.
The HECMs are insured by the government. So they have sole discretion to determine. There are programs to forestall, put off a foreclosure, to give either the borrowers or family members a chance to get caught up on any property taxes or to transfer a property when needed. So there is an application to go to, and HUD is the one that decides that, as opposed to the bank. So it's good information to know that the bank does not get the final say in that, and you can get more information elsewhere.
Believe me, guys, if you're listening, believe me, you would much, much rather have HUD telling Carrington or PHH when they can and cannot foreclose than leaving it to themselves. Because I've said this repeatedly, these are two companies. Carrington is one, and PHH is the other, who are just, in my view, dishonest to their core. And by the way, it's not just my view. All you have to do is look at their record. They've been every couple of years they get fined, they get shut down, they get the government is after them constantly. They pay massive settlements on a regular basis, and their bad business is such that it is so profitable to act poorly that even with government restrictions put on them, even paying massive payouts. When I say massive payouts, I'm talking hundreds of millions of dollars at a throw, if not more, and it's still profitable for them. Because they're so large, and because, if 10% of every reverse mortgage, for example, that PHH has, they roll up $5,000 to $10,000 in, forgive my language here, but nonsense fees. I had a different word, but Jane's kicking me under the table.
Yeah.
Nonsense fees. Imagine how much money we're talking about.
Yeah.
You can easily afford to pay a $100 million penalty for nonsense fees if you're making $200 million. Or if you get one of these ridiculous settlements where HUD requires that they only, or the CFPB only requires that they pay back 15 to 18% of the money that they know they stole. I mean, what kind of nonsense is that? You steal money from your own consumers, and the government group that watches over says, okay, we caught you. We caught you red-handed. But instead of actually, sending anybody to jail, which is what's going to put an end to this, or ending the company's ability to exist, instead what we're going to do is we're going to insist that you pay back 18 to 25% of what you stole.
And not do it anymore.
Yeah, and stop doing it, which of cource they do anyway. They don't stop doing it.
Well, that's the problem. It's an entity. It's not a person. So you can't put an entity in jail. And the problem is new CEO might come in, new leadership, and then they can say, well, it was their problem.
It was the other guys. The dog
fault.
ate my homework. It's interesting you should say that, because not that I'm espousing this for this country, but in other countries, if you are a board of directors, if you are a CEO for a company, and that company does wrong, you go to jail. In some countries, not ones I want to hang out in, they kill you.
Might change some behavior here.
Yeah. There's a large Chinese firm, I was just reading about it this morning, who has gone bankrupt. They're a real estate firm, they've gone bankrupt. Their board of directors is going to jail because you're not allowed to go bankrupt. And more importantly, they're going to go to jail because they were lying to essentially they say shareholders. I'm not sure how that works in China, but they were lying. So without question, these guys are going to all spend time in Chinese prisons. And they're all going within the next few months. This isn't going to take years to follow this out. I think our problem in the United States is we have this ridiculous idea that corporations on one hand are people, so we have to give them the same respects and rights as people, but yet we cannot discipline them like people. And again, when the discipline is just a small percentage of what you've stolen, not your profits or anything else, just a small percentage of what we know you stole, how is that viable? I mean, it's just complete and utter nonsense, and it's particularly bad in the reverse mortgage industry. So the bottom line with reverse mortgages is this. Correct me if you think I'm wrong. They're very expensive to get a hold of. They're not bad. I mean, if you need them, you need them. And sometimes they're the best option you have. My mom has a reverse mortgage. I don't think anything wrong with them in general, but they do tend to be much more expensive. And there are more pitfalls, and a lot of those pitfalls are hidden. So you've got to pay attention. So if you get in trouble with a reverse mortgage, give us a call. I give out my phone number all the time. I'm not going to ask Jane to do that. Again, she's smarter than I am. My phone number is 661-714-1400. Again, 661-714-1400. And you can reach me at that number 7 days a week, 24 hours a day. I've gone up several times while we're sitting here. I always get calls during the show. And I'll be happy to answer your questions. I'll be happy to help you out. We do this totally for free. So if you've got a reverse mortgage, you have a family member who does, you're having a problem, or you think you're having a problem, give us a call. We can help you out. Sometimes it's just a matter of talking to you on the phone. Sometimes it's getting into a file. Give us a call. In the meantime, let's hear from some more sponsors. When we come back, we'll talk about some charity stuff and how we move the needle for people. Talk to you soon. It's the Real Estate Fix. I'm your host, Rich Szerman, and we're talking all things real estate as we do every Friday morning on KHTS 98.1 FM, AM 1220, your hometown station. Certainly my hometown station. I hope you're making yours too. Right, so today we're talking about, we talked about market updates. We talked about, we're here with special guest Jane Szerman, my wife, and real estate attorney extraordinaire, who also holds an MBA and who's a 33-year practicing attorney. It's been 33
Something
years?
like that. I stopped counting.
It's a long time. Yeah, because she started practicing when she was 7. She was just that smart. But yeah, she's a practicing real estate attorney. Has been doing this for a very, very long time. She certainly knows what she's talking about. Obviously, consider your source. I'm her husband, so other than her strange choice in men, because we know she could have done better, but I make you laugh, so I got that going for me.
That works.
I'll keep you going. Anyway, but I want to talk about some of this. The third segment of the show, I want to talk about some of the sort of stuff we do and some of the victories we've had of late. We got a lot of response to what we're referring to as the Beverly Fox article, which is about reverse mortgages. Jade and Menchie put together an article here at the station about it because she is in danger. She's 90 years old. She's about to be 91, and she's in danger. She lives in Canyon Country, and she's in danger of being thrown out into the street because of a foreclosure over the same occupancy nonsense. Because they decided, to give you a brief recap, her bank, PHH, again, one of the worst in the country. And that's just not my opinion on the subject, although it is. That's also, there's statistics that back this up. There are also fines and lawsuits that also back this up. PHH is horrible. We say that with complete confidence. They treated her poorly. They put her into foreclosure unnecessarily. This is what I was just talking about, where they supposedly sent people to her house who never got to her house because apparently the guard gate at Friendly Valley is just too much for them to navigate. They even did a full-blown appraisal, and there were pictures of the house in the appraisal that they decided was vacant, where her houseplants are there, and it's all, and their knickknacks and stuff. People, houseplants don't tend to live if the property is vacant. But still, they couldn't decide she lived there, and still they didn't do any proper follow-up. Now, they put her into foreclosure. They would not budge. PHH would not do anything. Pay us or lose the house was kind of their attitude. But suddenly that story aired, and Jade got on the phone to PHH and asked them their opinion of it. And while I'm sure they have a different court, their version of events is very different. Suddenly the problem was fixed. Suddenly Beverly is no longer in foreclosure. Suddenly her file is fixed, and now we're just arguing over the fees that they charged. But at least she is not worrying about being thrown out of her home anymore. And the reason for that, and I will say this without fear of contradiction, is because of the story that Jade did. Because of the story that KHTS did. But more importantly, because of the 20 to 40,000 people, depending on when you looked at the story, who looked at that story. Because of the view count on YouTube and on the station's channel and on Facebook. Because so many people from all over the world looked at that story. And then we went to PHH and said, hey, I got 20, 30, 40,000 people who have seen this story. You might notice there's no end to this story. There's no real wrap-up to it. So you guys at PHH are in the very enviable position of writing the end to your own story. You can tell us it was great. You can tell us it's horrible, whatever. But so you guys have two options. You can be the guys who save this woman's house, or you can be the jerks who throw out in the street. You decide. And in this case, they made the right decision. And they will tell you that they came to this themselves, and they did it before. But meanwhile, the day before that story ran, her house was scheduled for foreclosure several months from now. Yeah. The day after that story ran, it was taken off calendar. The day before that story ran, she was in active foreclosure. A week after the story ran, no longer in foreclosure. PHH did not do that out of the goodness of their heart. PHH did that because they have a public face and they're about to get in trouble yet again. Because PHH, and I keep saying this, I'm going to keep saying it until it changes or I die, PHH steals from little old ladies and then tortures them by threatening them with foreclosure. And I would encourage somebody from PHH to correct me on this because I think the facts are on my side. I contend that PHH steals from the little ladies and then tortures them. I have yet to hear from somebody at PHH to contradict that. Although they did send us a statement at one point saying they treated Beverly Fox properly, which is demonstrably untrue. But the point here is, even when the bank says, even when an institution you're arguing with says, we will not budge, yeah, you will. Even if they say, we can't do that, it's against our policy, yeah, you can. And yeah, no, it isn't. It's a matter of bringing you guys, you listeners, you guys who listen to the show, you guys who click online, you guys who like, you guys who comment online. It's you guys that give us the power to fix this. Beverly Fox, a very, very lovely woman who lives in Canyon Country, will be able to stay in her house for the rest of her life because of you guys. So thank you. Because of Jade and the news station here, because of Menchie, because of the work we do, certainly. But ultimately what it comes down to is PHH yielded to public pressure. You guys got online, you guys commented on the story, you guys watched the story, you guys responded to our show as well, and it's because of you guys. So thank you. For those of you who listen, those of you who get into this, I really, really appreciate it. And Beverly Fox appreciates it even more than I do. So thank you. Thank you very much for doing that. Now, before we go, I want to mention a couple of other things. And I want to thank Janie for hanging in. I don't really have any questions for her. I just like it when you're in the room. It's just better when you're in the room. Anyway, a couple of things I want to mention. First of all, our friends at AC Dave asked us to promote this, and I really want to help them out because this is a good cause. At Casa Gutierrez, which is a restaurant in Leona Valley, 8847 Elizabeth Lake Road, Leona Valley. Let me say that again, 8847 Elizabeth Lake Road in Leona Valley. Casa Gutierrez restaurant. And at Casa Gutierrez, they are doing a fundraiser, and it's a fundraiser for to support families in recovery from addiction and victims of domestic violence. And they're donating 10%. That's a lot. 10% of all of their proceeds on the day, October 1st from 11 to 3 p.m. October 1st from 11 to 3 p.m., which is a Sunday. I'll be there. Sunday from October 1st, 11 to 3 p.m., 10% of everything they make is going toward a good cause. So BBMS is the name. Hopeful Family Futures is the cause. So come on out and support them. Again, it's 8847 Elizabeth Lake Road on Sunday, October 1st from 11 to 3 p.m., and it's Casa Gutierrez. So please come out and support them. And thank you guys for listening. I really appreciate it. We love it when people do this. And thank you guys for reacting to the Beverly Fox story. I really, really appreciate it. I'm your host, Rich Szerman. This is the Real Estate Fix this has been the Real Estate Fix on 98.1 FM. AM 1220, your hometown station. I'll be back with you next week, and I think next week we're going to talk about insurance because there's some stuff going on in the insurance industry regarding houses that is a bit of a concern. So we'll talk about that next week. So thank you guys for listening. Have a great week. Be good humans, and I will see you next week.